In this episode of Connected, we took a look at cash flow planning, how it can be used, any pitfalls, and how it can bring a financial plan to life for your clients. Discussing this with me was Steph Willcox, Head Actuary at Dynamic Planner. Now let's start with the big picture. Why should advisors be using cash flow planning tools at all?
So most of the time when you go see your advisor, your clients are going to see their advisors, you're trying to make plans today for things that you need to do with your money right this second that probably won't have an impact for 20, 30, 40 years time. With all the advisors looking to get younger and younger clients, we all know that our attention spans are not so good. We can't focus on doing something today if we think we're going to get this payout in 50 years time. So cash flow planning is really how you can bring that to life, how you can show an impact today of making that choice and then showing them the exact impact that's going to have on their cash flow plan, on their finances through the whole of their life because of the decisions they've made today. So really that's that vital thing about cash flow planning, right? You're trying to generate some buy-in into the advice you're giving them in the hopes that they will then go away and stick to this plan and not get distracted by things going on elsewhere.
Okay, brilliant. So bringing money to life. And what does the FCA say about it? What's its position on cash flow planning and modelling?
For a long time, we didn't have anything from the FCA about what good cash flow modelling was. It obviously got reference in some legislations, that an awareness that people were using cash flow modelling tools. But that all changed when the retirement income thematic review came in last April 2024. And at that time, the FCA did go into more detail about what made good cash flow planning. And they were quite explicit about some examples of what firms were doing that was good and what firms that were doing that was bad. And that made it a little bit clearer really for people and the things they should be focused on when they're doing cash flow planning. In particular, I mean, as you can imagine, the FCA were mainly focused on basing their cash flow plans on up-to-date information. You can't be putting a cash flow plan in place, leave it running for 5 years and assume that everybody's still paying the same incomes, got the same expenditures. It's just not a valid way of creating cash flow plans. And then obviously one of the other really key features was the justifiable rates of returns. So cash flow modelling tools all across the industry do things differently. Some have baked in assumptions that you can't change. Some have assumptions that you can change yourself or your firm can change at a higher level than you. But the key feature that the FCA wanted to see in any of the cash flow tools that you're using is an understanding of why you're using those rates of return to make sure that you're treating customers the same. If they're invested in similar products, they should be projected in similar ways. So I think those were the two really big ones that came out of that. But obviously there was a lot of information that the FCA actually gave, which was so different to how they had approached it before, where they were just not giving any information at all about what a good cash flow model might look like.
Okay. Now, what do you think is particularly important in cash flow modelling?
So like I say, I see cash flow as really being this generate buy-in. It's almost a sales tool for the advisor. So the way that you can really get that buy-in is to make it really personalised. If you're showing people the goals that they've actually talked about with you, particularly at the moment, if they've decided that they're going to retire at 50, you want your cash flow model to be showing that. If they've talked to you about the fact that they don't want their children to come out of university with any debts, then you need to be putting these types of things into their cash flow model. Because if they can see these little events through their life and think, oh yeah, that is something I wanted to do, and you can demonstrate that they have no chance of meeting these goals, but following your advice, they now have a really good chance of meeting these goals. That's where you're going to generate that buy-in, isn't it? Once you're bringing a real person's life in front of you to life, that's what it is. So I think that is where people should be putting their efforts into making sure that it's really personalised to the clients in front of you, rather than necessarily getting distracted. Obviously, cash flow modelling can take hours, it could take days if you wanted it to. And I think if you just make sure that you're focused on your clients and the people in front of you, because once they can see themselves reflected back at them, it's just going to make conversations so much easier.
And you talk about cash flow planning being kind of adaptable earlier. How often do you think it should be happening? And are there any triggers for a sort of revisiting a cash flow plan?
Yeah, so obviously the natural point to kind of look at your cash flow plan is going to be an annual review, simply because you're already talking to the clients. You're probably collecting more data. You've probably got a good base there to go back and to look at the plan again. But equally, it could be happening because of a life event. You know, if something has happened within the family, if they've suddenly got an inheritance that they want to invest, they've got a big bonus at work, anything like that, that where there's more inflow coming in, could be a really good time to sit down and assess, you know, well, we had these goals planned out, but now you've actually got some more money where we could do something different. It's really any time where clients are trying to make decisions about what to do with their money. You want to be looking at that cash flow plan, even if you're not revising it. Getting it back in front of your clients to have those conversations could just be a really vital approach.
What about, you mentioned the FCA's sort of focus on assumptions there. I mean, how do advisors deal with kind of macroeconomic uncertainty, I suppose, or, you know, some of the changing, you know, if clients' risk profile is changing? How do they incorporate that into a plan?
Yeah, so macroeconomic wise, I think it's really important that you don't get dragged into short-term fluctuations in the markets. We know that cash flow plans are long-term projection vehicles. We don't want to be thinking, oh, everything's changed, I now need to go through and update all of my cash flow plans. What we're trying to do is give clients an idea about what their finances are going to do in 20, 30, 40 years, given normal market conditions. We're going to have fluctuations in that time. And that's something that obviously as advisors, we need to go to our clients and talk them through and make sure they're comfortable with the level of risk that they're taking and the volatility that they will experience just by being invested in the first place. And then on the side of reflecting the correct risk levels through time. So obviously different cash flow tools do this in different ways. If you have a cash flow tool that is looking at the risk of your portfolio, that's expected to stay quite stable through time. We're going to project you on that risk. You're probably going to remain that risk for 40 years or so. We don't see a huge difference in people's attitudes to risks changing through time. There is a lowering as people get older, but in general, people's attitudes to risk stay quite stable. If you're projecting on individual fund basis, that's also fine as well. But what you need to be thinking about there is the funds that they're invested in today, is that reflective of how they should be invested? Because we know that obviously if you're in passive funds or active funds, however you're dealing with it, people can take strategic decisions to go away from regular asset allocations. And you don't want to be making a projection based off of something that's gone really away from the standard asset allocation. So if you're projecting on funds alone, it's really important to make sure that is an appropriate stance for the next 20, 30 years. You know, you're not going to be invested in this fund for that length of time, but at least the characteristics that it's representing will be something that you're invested in that time. Okay.
So not assuming that the tech sector will keep sort of delivering this, 20-year returns, that kind of thing. Okay.
Yeah. If we knew that the tech sector would do that, I think we would all be investing in that. We'd all be very rich, but we don't know that. At some point, that won't be the leading stock, as we all know. So things change through time, but your characteristics don't.
Yeah, absolutely. And just finally, I mean, what do you think are the common pitfalls that advisors encounter when using cash flow models? And is there anything you can suggest that would help them get over those?
I think different advisors use cash flow modeling in different ways. Some people like to keep it really simple, just so they can have that conversation with their clients. You know, they'll chuck in just one lump of income, one lump of expenditure, and then just show them what that's going to mean for their life, which is a completely valid approach, particularly if you've got thousands of clients that you're wanting to get through in terms of cash flow planning. Other advisors get really hung up on details. So they want to know everything to the nth degree, which I think isn't always going to be appropriate when we're talking 20, 30 years in the future. But the FCA does talk about this too. So if your clients have come to you and they've given you their list of incomes and their list of expenditures, and you can see that they should have a surplus of £1,000 a month, but they've got no cash savings, they've got no investments that they're putting money into every month, that level of detail that they've given you is actually a really good indication that it's not a valid piece of information that you've got there. So saying that you want to balance out that need for the data that clients can give you is really important, because you do want that detail to check that the data you have is correct, but you don't necessarily need to feed every single piece of information through to a cash flow plan. Now, on the other side of that, I think goals wise is where it's so important to get that detail in. I think if you've decided that you want to buy a house on the beach, you've decided that you're going to go on a year-long cruise around the world, this is type of information that you can get into a cash flow plan really quickly and get some really good payout because the clients can see themselves in that cash flow plan. And then, of course, the other side of things, the assumption side of things, is where advisors can also get caught up. Or does this fund get an extra 0.2% of growth this year? Should I put that in? Should I put this in? And I think on this, we need to be taking broad brush long-term assumptions. That's what we're looking for. We're trying to give clients an idea of what their money can do. We don't want to be overly optimistic, but we also don't want to be overly pessimistic. If you're using a deterministic model where you've got one set of assumptions, we know you're going to have to run stress tests on this. You're going to have to show them what this looks like in poor economic conditions, as well as what it looks like in good ones. If you're using a stochastic model, of course, then that's already taken into account. So you've already got those lows built in. But it's really important that we are looking for the long term. It doesn't matter necessarily that we've got, 4% inflation this year, because we know that over the long term in the UK, we're going to trend back down to the target that the government has set out at 2%. So just making sure that you are focused on that long term rather than being so into the details of right this second.
So I think you may have addressed this already, but how would you suggest advisors explain cash flow modelling to clients in a really kind of simple and engaging way?
So this is a tricky conversation, right? Because some clients are going to be completely overwhelmed if you show them 17 different charts, or even an appendix full of just numbers. That's going to really terrify some clients, but equally some clients, that's all they want to see. They want to see those numbers in detail. So this is really where knowing your client comes into this. Most people are going to want to be using their cash flow tools in front of their clients so that you can move things around as you're discussing things, show people how things changed. Because obviously at the cash flow stage, we haven't really made decisions about what we're going to do with the advice process yet. We're not quite sure where we're going. We want to give clients the option to see a bunch of different things. But then knowing your client, and then obviously it's really key that when they go away from this meeting at the end, they've got a report to take away that explains things in a way that they'll understand. So focusing on the reading age of your report, the government recommends keeping that to age 9 or below, which seems insanely low. But having a reading age of age 9 just means that everybody that has a reading age above that can read through this report really quickly, understand what they're seeing, and they don't have to keep flicking back thinking, I didn't understand that sentence. What does that one mean? What do I need to go to a glossary? So it's just making sure that when clients go away at the end of the day, they're not going to be confused by what they're reading back on. It's also really important in those reports to cover everything you've discussed in the meeting, because you don't want people to go away thinking, I'm sure we talked about this, but I can't see any record of it. So it's just making sure that people have that clear messaging to go away with, so they can make sure when they go back and review it again, it's going to be the same conversation that you've had in the meeting that they can take away with them.
Great. We'll wrap up there. Thank you so much, Steph, for bringing that to life for us today. And thank you all for joining us.